The week closed on two numbers that most of the feed read as one. The volatility index at its lowest level of 2026, and the lightest weekly volume in the S&P 500 since February 2025. They sound like the same sentence, the market is calm, but they measure different things. Volatility prices fear. Volume counts participation. One tells you how the tape feels. The other tells you how many hands built it. Keep that distinction in your pocket for the next 7 minutes, because this week, the whole board is built on it.
2 weeks ago, we corrected something in public. Money flow does not front-run price. It measures how far the volume-weighted price has stretched from its own average, which means it follows. And that correction leaves an obvious question hanging. If the number follows, what is it good for? This episode is the answer, and it is step 3 of the method. You do not read momentum and money flow as two separate verdicts. You read the distance between them. Track the gap, not the level. Today, the board hands us that lesson on a plate because the gap is not one row this week. It is nearly every row.
Start with the index. SPY, at a record, at 776. 3 time frames on the table, and look at what momentum does across them. Plus 98 on the weekly, plus 98 on the daily, plus 88 on the 4-hour. Pinned. Now look at money flow on the same 3 rows. Plus 26 on the weekly, 0 on the daily, minus 4 on the 4-hour. That is the reading of the week. Not one of those numbers on its own, the shape they make. As the clock gets faster, participation drains out of the move while price pressure stays maxed. The slow clock still shows flow behind this advance. The fast clock does not. And remember the correction. Flow follows price, so a reading near 0 is not a forecast that price falls. It is a statement about the crowd behind the current level. This move is being made by fewer hands the closer you look, which is exactly what the volume number said from the outside. 2 instruments, 2 methods, 1 conclusion. And that is the strongest kind of agreement you can get, because neither one was built to confirm the other.
Now the layer that is not talking. The structure panel on this chart reads, no accumulation, and the last signal was 96 bars ago, back in April, down at the low, before any of this. Since then, silence, through the entire advance. That is not the tool failing. That is the tool doing what it was built to do, marking where trading actually accumulated, and staying quiet where price simply traveled. Relative volume reads low, which is the same story again from a third direction. And one more thing worth saying out loud, because it looks like an error and it is not. The weekly status reads contraction on a market printing records. Step 2 of this method. Status is the noun, momentum is the adjective. The noun says the weekly is in a compression phase. The adjective says that phase is going up hard. Those can both be true at once, and when they are, you do not get to pick the one you like. You name the disagreement and keep reading. Last Sunday, we made 2 statements about gold, on camera, and both have an answer this week. First, we called the weekly the widest momentum flow gap on the board. Momentum flat, flow stretched high. That gap has closed. The weekly now reads momentum plus 16, flow plus 8. But look at how it closed. It did not close because price fell to meet the flow. It closed because flow came down to meet the price. If you had traded that gap as a signal, the direction would have surprised you. That is why we read gaps as tension, not as instructions. Second, we asked whether the 4-hour recovery would reach up and turn the daily. Not yet. The 4-hour is recovering, momentum plus 72, and money flow minus 2. The daily still wears distributing, minus 14, with flow at plus 6. So gold's rally kept going, and participation stopped following it up. Same sentence as the index, different market. And the structure layer has now been quiet here for 743 bars, with relative volume that dropped from medium to low across the week. Run the flow column down the whole board, and it barely moves off 0. QQQ plus 2. Silver, 0. euro dollar around zero. One market breaks the pattern, and it breaks it in the opposite direction. Bitcoin. Momentum minus 46, the weakest on the board, and money flow plus 16, the strongest. That is the exact mirror of the index. Same tool, same gap, pointing the other way, which is the part of step 3 that is easy to miss. The gap is not bullish or bearish. It is a measure of how much the crowd and the price agree with each other. Right now, the index has price without the crowd, and Bitcoin has the crowd without the price. Neither of those is a trade. Both of them are information.
So what does a board like this leave us with? 2 questions, and no forecast. For the index, does money flow climb up to meet a price that has already gone, or does price come back down to where participation actually is? Both are ordinary outcomes. The gap closes from one side or the other, and last week's gold row is the reminder that it is not always the side you expect. For gold, does the daily turn and join the outer time frames, or does the 4 hours negative flow drag the bounce back? Acceptance and rejection are both results. The only losing move is needing one of them. Step 3. One more time. Momentum tells you how hard the market is pushing. Money flow tells you how many hands are pushing. Neither number is a signal by itself, and the level of either one is the least useful thing about it. What carries information is the distance between them, and which way that distance is closing. This week, the whole board is pushing hard with very few hands. That is not a warning, it is a description, and it is one we will check again next Sunday, in public, whichever way it goes. Thanks for reading with us.